I have the privilege of introducing our staff to everyone, and then we're going to bring Adam up, and he's going to introduce you to our guest speaker tonight. If you have any questions, let us know throughout the process. I think we're probably going to be done around 9-ish tonight, but we have the room until 9:30 if you want to stick around and ask questions after that. Feel free to do so. My name is Andy Barton. I'm a financial advisor at Libertas. I think I've had the chance to meet everyone in this room, but if I haven't, please come up and introduce yourself before we leave tonight. And I'm going to talk about our staff right now. So like I said, my name is Andy. I'm a financial advisor. We also have Adam, who is the president and portfolio manager at Libertas. He's here at the front table. And then we have Gina and Heather, who are both in the back right now. Gina is our director of operations, and Heather is also a financial advisor at our office. And then most of you have probably not had the chance to meet Tyler yet. He is starting on Monday as our new intern. Tyler's going to be a senior at Ohio State this year. So again, thank you all for being here. Any of us can help out with any question that you guys have tonight. And we're always happy to meet more people. I'm going to brag a little bit about our company before we get started. So most of you probably have heard this before, but those of you that are new in the room, one of our biggest accomplishments was in 2011, the Better Business Bureau nominated us the Torch Award for Ethics and Trust. That is huge in our industry. Thank you. So we joke around that we're always at the very bottom of the totem pole, one step above like a used car salesman or an attorney. So, this is big in our line of work. And then the next one over here on the right is for 5 years in a row, and we find out about year 6 in about 2 or 3 weeks, we have been named the best financial advisory firm in Columbus, Ohio, that's voted on by you guys, our clients. So in this, thank you. We're up against the big names like Morgan Stanley, John Hancock, Ameriprise, Charles Schwab, Edward Jones, and we have won this award for 5 straight years. So thank you for allowing us to do that as well. For those of you who are not getting our market commentary yet, if you want to be on that list, please let us know. One of us at the office usually writes an article for a Monday night, Tuesday morning send-out. And we also have been recognized on a lot of these different media outlets as well. If you just Google our name. If you have not checked out our website lately, about 3 or 4 weeks ago, we updated our entire website. It looks totally different now, and it's working out finally pretty well for us. So now I'm going to introduce Adam, who's going to come up and talk a little bit about our portfolio management strategy, and then he's going to introduce you to our guest speaker tonight as well. So I think most of us in the room know who Adam is, but a couple of Adam's biggest awards are back in August of 2010. Adam won the 40 Under 40 award here in Columbus, which was named by Columbus Business First. There's been some other great winners like Mayor Michael Coleman and restaurateur Karen Mitchell as well. In November of 2014, Libertas and Adam were named to the 5-Star Wealth Manager by Columbus Monthly Magazine. And then another one that Adam got back in 2011, Financial Advisor Magazine does this on an annual basis. And Adam was named one of only 8 portfolio managers to the Research All-Star team nationwide. So another great example of how much your portfolio manager likes what he's doing and knows what he is talking about. And then again, in July of 2014, he was named the 20 people to know in finance here in Columbus. So I think we have all had the chance to meet him before, but please help me welcome Adam Koch to the stage.
All right. Andy was up here, so I have to move this down. Yeah. All right, so normally at these events, I'm going to leave this on. Normally at these events, I would give some sort of market update, talk about what's going on in the market, but I'm going to leave you in suspense because the market went down more than it has in so many months now. So we're not going to talk too much about that. I'm going to let Tommy talk about that tonight. But instead today, what I wanted to do is I wanted to kind of give you a little kind of evolution of our portfolio management process, where we've come from, in the very beginning. In fact, somebody over here at one of our tables, we were just talking to Lawrence Dennis, who's one of our first clients we've ever had for all 14 years, when I was literally going door to door in 20-degree weather, and I knocked on his door, and his Force Recon sniper son stared me down as I sat in his living room, as I considered leaving, as you could probably imagine. But back when I started in this business, we're all hired to, a Morgan Stanley, an Edward Jones, a Smith Barney, a UBS, a Merrill Lynch, and we're all trained the same way. We're all trained to go out, find a bunch of investments, find some mutual fund companies you like. There's wholesalers that come and they'll buy you golf and they'll buy you dinners and they'll tell you this story about how you need to sell their mutual funds. And then what you do is you go regurgitate that story to your clients and you try to get them to buy stuff with you, and then you go find more clients. And as Andy always likes to say, then what happens is 364 days later, the night before your client comes in, you look at your statements for that client who's coming in, you find out whatever did the worst, and you tell them you're going to sell that tomorrow, and then you go find more clients. And that's how we're all trained. I know you're laughing, but it's true. That's how we're all trained in this business. So I started in this business 10 days before the New York Stock Exchange crashed after the World Trade Center went down. So 10 days before the World Trade Center went down. The market had already been going down for about a year. And I was 21 years old, and the average financial advisor at that time started in the business at 42. So everybody's coming to me saying, wow, you're so lucky, you're getting this business at such a young age, imagine what you can do. And by the way, the market's been going down for a year, so what's going to happen is all the money you invest is just going to go up, and you're going to look like a hero. Then the World Trade Center went down, right? And what'd the market do? Well, the market closed for a couple days, actually, right? And things didn't go so well. For the first year and a half of my career, all I did was watch our portfolios go down in value, and everybody that hired me lost money. So then finally the market started coming around. 2003 it was up. 2004 it was up. 2005, 2006. Then in 2007, things start getting hairy again. Market starts going down again, and people on CNBC, mutual fund analysts, they're telling us on TV, this is going to be a shallow recession. It's going to be very short. Don't worry, everything will be fine. You haven't lost anything unless you sell it. Just hold on. And I'm going, oh my God, I feel like I'm in training again, And after we're down about 20% at this point, and I'm on the phone, on a conference call actually, with one of the top mutual fund managers in the country. He's on Barron's top mutual fund managers list every single year. And at the end of these conference calls, you have the ability to hit *1 and ask a question. And on this phone call, this mutual fund manager, again, top-notch guy, PhD, CFP, CFA, silent H, K, F, whatever, all the alphabet soup. He says during his conference call, unlike the CNNs and Fox Businesses and CNBCs, I think that this recession is going to be very deep and very prolonged. And I'm sitting there thinking, man, everybody else is saying the opposite. So I hit *1 at the end of the call. I said, can you tell me why it is that we're so heavily invested in the market if you think that this recession is going to be long and deep? And he doesn't say anything for a second. And then an attorney breaks in on the line. And the attorney says, well, as you guys know, and he's talking to financial advisors on the call, he says, as you guys know, we have an investment policy statement we need to adhere to. Now, inside that big, thick prospectus that nobody reads that come to your house all the time, the ones you use to start fires, if you have wood-burning fireplaces, that is, in about page 10 to 15 is what's called an investment policy statement. And in that investment policy statement, it says on most mutual funds, you could pick a company name, doesn't make a difference. It would say, XYZ mutual fund must stay invested at 90% at all times in U.S. stocks. So it doesn't matter how smart the mutual fund managers are. It doesn't matter how much experience they have. Now, their portfolio at home is probably doing just fine, but your money that's inside their mutual fund, all of a sudden it hit me. It's like, no matter what I do, I can just keep blaming these mutual fund companies, but at the end of the day, when the market goes up, we're going to make money. When the market goes down, we're going to lose money, right? So that's when I sought out one of my friends and mentors at the time. He's still a friend, but he's one of the top, if not the #1 financial advisor in the country. You've got to be doing something better than little old me in Dublin, Ohio. So, can you tell me what you're doing? And he let his secrets out, and he told me technical analysis is the way to go. So, in 2008, I signed up for this company, and I started learning technical analysis and charting and all the nerdy stuff you guys see me write about every week. And it worked really, really well. If you back-tested it through 2008, if you looked at 2009, our aggressive portfolio was up 45.5%. Market was up 26, and that was after fees, by the way. So things were going great. But then 2010, we were down by about a point, which was fine. Nobody's complaining. But then 2011 got really tough. 2012 got worse, and I'm sitting down with the guy, and I said, and he became a very good friend of mine. I was on his board. I used to train financial advisors how to manage portfolios using his software. And I said, you got to tell me how this software works. You got to explain the algorithms to me, because when I buy Netflix, which is my nemesis stock of all time, by the way, when I buy Netflix and it's down 20% and I haven't sold it yet, that makes me uncomfortable, but I don't know why we still own it. And he wouldn't tell me. I'm letting the cat out of the bag here for some of you who are with me that long, who were back in the Netflix days. And I gave him a choice. I said, either you teach me how this stuff works, you teach me what's inside of the black box, or I'm leaving. And his biggest competitor was a guy by the name of Tom Dorsey. And I said, if you don't teach me how to do it, then I'm going to Dorsey Wright, and I'm going to hire them, and I'm going to do their research, and I'm going to learn their way. And he wouldn't teach me, so I left. So that was when I hired Dorsey Wright, and that's how, I again went back to the school again, basically, if you will. And Tommy will talk a little bit about that later. But I've spent, basically over half of my career now learning technical analysis and learning how to chart and learning what relative strength is and understanding support and resistance levels and bullish percent charts and percentage trend charts and all kinds of other stuff that you'd have to look up on Investopedia if you're writing all this down, right? But that didn't get any laughs at all. That's better. When you say it doesn't get laughs at all, then people laugh. See how that works? So anyway, I guess the other thing I wanted to say was, I made the decision, obviously, to go off the reservation and change our money management philosophy. Not only was that monumental in regards to the future of our clients' portfolios, but it was also life-changing for me personally, because at that time, for any of you that know me pretty well, you know that I love what I do. But at that time, all of a sudden, it was becoming work. I didn't like it anymore. It was like, so basically, I'm going to buy mutual funds, and the market's going to go up and we're going to make money, and then the market's going to crash, and I'm going to lose money, and then I'm going to blame mutual fund companies, and then I'm going to tell people to stay with it, don't worry, it'll come back. That's my story. So basically, I just have to tell people, well, you like redheads better, right? And you have to tell people, you like me better than the other guy down the street that does the exact same thing, because 90% of the country manages money the same way. So I went off the reservation, and for the first time in a long time, I felt reinvigorated and excited. So, with that, again, I don't want to let too much of I already let a couple cats out of the bag, so no more kittens. But let's tell you a little bit, about Tommy here, who we're very honored to have. He, first, it's not in his intro here, but Tommy sold his company for, was it $240 million in March. And on the day he sold it, I called him up and I said, hey, since you're not doing anything anymore, you want to come talk to my clients? And I don't know if he regrets it now, but he said yes. So we just picked him up today, and he and his wife Cynthia are here, and we really appreciate you guys being here. But Tom Dorsey began his financial career as a good old-fashioned stockbroker at Merrill Lynch, Pierce, Fenner & Smith in 1974, and then was offered the opportunity to manage the options strategy department at Wheat First Securities. In January of 1987, let me repeat that. In January of 1987, he left Wheat First Securities to start Dorsey Wright and Associates as an outsourced options strategy firm. It's great timing, isn't it? Anybody remember what happened in 1987? Little thing called Black Monday? Yeah? Tough time to start. So after the crash of Black Monday, Tommy realized that the options business would never be the same, and as a result, he changed the company's focus from an options strategies firm to a technical analysis research firm, primarily because any options strategy has to first begin with researching the underlying stock. Again, he'll get into some of this when he gets up here, but today, Dorsey Wright & Associates has clients spanning the globe, including us, of course, and they also sub-advise well over $5 billion of assets around the world. Tommy has 40 years of experience in the financial services industry as an analyst and entrepreneur. He's the author of 9 books on the subject of technical analysis. And if you lived in New York City, you'd be familiar with seeing his name on the marquee in Times Square, as he spent a lot of time on Wall Street ringing the opening bell on NYSE. Anybody know what an ETF is, exchange traded fund? Raise your hand if you do. Okay, a lot of people, good, that means I'm doing okay. So many exchange traded funds, ETFs, that you can buy right now today on the exchange exist because Tom was the architect of these ETFs. In fact, I think it's safe to say that he's been one of the leading architects of tactical ETFs, tactical exchange traded funds, a global investment that's quickly gaining popularity. In fact, it's estimated now that within the next 10 years, ETFs will have gained a majority total market share of client money over that of mutual funds, which I think is really interesting. He is regularly quoted in the financial media and has appeared in numerous media outlets, including Bloomberg Television and Radio, CNBC, and was formerly a regular on monthly guest on Fox News, Cavuto for Business, and Bulls and Bears. As you'll soon find out, Tommy is an award-winning speaker and is one of the biggest technical analysis trailblazers of our time. His personal interests have also led to recognition as he's a former AAU world record holder in powerlifting, and he's also a current U.S. record holder in powerlifting as well. He's completed the Adventurer's Rickshaw Run from North to South India, as well as being a former FAA licensed hot air balloon pilot. He has a pilot story for us too, I think, today. So without further suspense, I know that's a long intro. It's with my heartfelt thank you, first of all, that I have the enormous honor of introducing you to an unbelievable, successful entrepreneur, a brilliant chartist and analyst, a great husband, a cool father, a life-changing mentor, and an all-around good man that I'm proud to call my friend. Tommy Dorsey.
That was a lot, Adam. Let me turn this on here. All right, I'm mic'd up. I like to move around a little bit sometimes when I talk. You all can hear me, right? Let me start out with saying, OH. It worked. My wife she made me do this. I said, what is OH? She said, we have a friend up the street, her best friend up the street, her husband is a graduate of OH, University. And she made me do it. And I said, oh my God, what am I going to, if I say OH and nobody says anything, what do I do? She says, then what you say is, apparently you're not Buckeye fans. And we'll go on from there. It worked. I can't believe it. Okay. Well, you know, when I'm listening to Adam and he mentions I used to do all of these TV shows and things. I don't do it any longer, until one day, Jim Rogers, who's a good friend of mine, some of you may know the person, he and I were on Cavuto on Business on Fridays. And we're sitting in the green room one day, and Jim said, he said, Tom, you know, he said, this is the least important thing that we do. I said, you know, Jim, you're right. I said, why are we doing this? I stopped right then. I thought for a second, I said, we have the technology to do our own thing. We do our own TV. It's called a webcast. We can do anything, send it around the world from anywhere. In fact, we have even had people, in fact, every St. Patrick's Day, we do it from Ireland. We do it from a pub in Ireland. Can you imagine that? People would send us emails and say, God, that's so great. You guys travel so much to go do these podcasts and webcasts and whatnot. It's fantastic. It's a green screen. We can do it from anywhere, anytime, any place at the drop of a hat. So technology-wise, I said, this is it. I got to get off public enemy number one and start doing it ourselves. And that was a total breath of fresh air in doing that. Before I came here today, I emailed Adam and I said, I know he does what we do. I mean, he is one of our disciples. He's a missionary, in essence, in our army. And I'll tell you how that has happened. But I said, I'd like to know exactly what you do with your customers' accounts, because he does what we do call the dynamic asset level investing, tilt, and things of that nature, terms that we know mostly. But he sent me a long dissertation of exactly what he does. And as I'm reading it, I get partway through it, and I wanted to stop and stand up and say, hell yes! This is the way I envisioned it to be done. And I thought to myself before I could even finish it, I need to reproduce this and send it to every advisor I know. Then I thought, no, because they might compete with Adam. So I won't do that. But it was so refreshing to me to see someone do this exactly as we anticipated and planned. Dorsey writes a firm of attraction. We're not attraction, not promotion. We had no sales, no advertising, no marketing. We are, in essence, missionaries. When I started this business, that almost went in my eye. 41 years ago, There's not many people that you'll find on Wall Street that can go back 40 years and talk about what the markets were back then. We're getting kind of old. But I started at Merrill Lynch, Pierce, Fenner, and Smith when it was called, it was real name back then. I was owned by the partnerships, and I was a stockbroker. And when I finished my training at Merrill Lynch, I came back to the office, and basically I was given a book. Here's the phone directory, and here's your phone. Start dialing. So that's what we did, because we didn't know any different. That was back in the day when you could dial people up. You didn't have no call lists. So I would dial people up, and I'll never forget what I said, because I said it 100 times a day. Good morning, Mr. Jones. My name's Tommy Dorsey. Now, I loved being named Tommy Dorsey, because there are some people here still remember Tommy Dorsey? It was great for prospecting. You know, today it has to be Justin Timberlake or something like that to actually work. But I'd say good afternoon, sir. Mr. Jones, my name's Tommy Dorsey. My company is Merrill Lynch, Pierce, Fenner, and Smith. The reason I called is twofold. First, I'd like to introduce myself, and second, I'd like to avail the services of my firm to you. Do you invest? Open-ended question. And this is in 1974, around October of 74, right after everyone had been totally wiped out between 1972 through 74. That wasn't one of these flash crash type of things where the market went down precipitously in one day. This happened over a 2-year period. It's like the blood came out drip by drip by drip until finally the customer was dead on arrival. And I'm now in my 20s, and I'm going to help them. I'm here to help them. So invariably, at the end of my spiel, they would say, Mr. Dorsey, we don't want to become acquainted with you. You can go to hell. And they'd slam the phone down. And I'd say, oh my God, nobody in training school told me that this was going to be like this. And they didn't even tell me there was a bear market. They didn't even tell me that 72 through 74 was untenable and nobody made any money. It wiped people out. So no one had told me about this, and I continued to prospect. And after my first year in production, I sat back and I thought, boy, this is a difficult business. If I'm going to be successful at this business, I've got to become an expert at something. I need to be the go-to person where you come and ask me the question. And I thought to myself, what am I going to do? Options had just debuted in 1974, in April of 74, and it was a relatively new product. Options are as old as the 1500s, but they were now traded on an exchange. I said, that's my direction. I can become more of an architect with accounts rather than just doing what research tells me, because at Merrill Lynch, what you were supposed to do is what you're told, when you're told, how you're told, then stop. Don't go any further. We'll send you the research. You sell the research. I thought, I can't do that. There has to be a better way. So I began to learn everything I possibly could about the options market. It was relatively new. There were no books on the subject. I just went home every weekend with a legal pad and a pencil and started doing basic arithmetic until I knew it cold. So I continued in that direction. My business got much better. It got much more conservative, because back then nobody had to worry about retirement. You worked for DuPont, or you worked for Philip Morris, or you worked for these big companies, and you had a defined benefit plan, so all you had to do was stay alive to the end. Stay in the gym, stay in shape, you get your money. So when they called us up, they're looking for a trade. Trading was Las Vegas. All we tried to do was find trading ideas. So once I embarked on this path, my business began to get much better. Using options, I was more conservative, lowered the volatility in portfolios, I was more successful. And ultimately what happened was, and this is where it begins on why I'm here today, the epiphany that happened to me is I was asked by Wheat First Securities, which was a large regional firm, to come across the street and develop and manage their first options strategy department. And I jumped at the chance. This is the greatest opportunity you could ever have. So I went across the street. They gave me an open checkbook, carte blanche, do whatever you need to develop this business. We want to be in the option business. So I sat down my first day and I said, okay, let's ask yourself a pointed question. What do you know about the stock market? After being a broker for a number of years at Merrill Lynch, what do you know? The answer, nothing. You did what you were told, when you were told, how you were told, and stop. Well, if I was going to be successful in this option department, I needed to become self-contained. I need to be the man. If I'm going to sink or swim by how good I am. Well, since I'm not very good at it, I got to hire someone who is. So I searched Wheat First Securities high and low. North Carolina, in our Charlotte, North Carolina branch, a fellow named Steve Kane responded to me, moved his family up to Richmond, Virginia, to help me develop this department. And the first day he walks in, this is where my life changes. He brings a little red and white book, about that big, not too little, paperback book, written by A.W. Cohen in 1955, and it was called The Three-Point Reversal Method of Point and Figure Stock Market Trading. Sound like something you want to curl up with at night, right? In the bed? I didn't want to either. He gave it to me and he said, please read this book so you'll understand the operating system in my mind. When I come to you about the market in the sector or stocks and whatnot, you'll understand how I think. I said, okay, I'll do it. Cindy, my wife right here, will tell you, I took it to the Virginia beach with us that weekend. We were going down to the beach. And I think it might have been the last time we were at the beach. But I'm laying in bed that night. I turned on the light by the bed, and I read the first paragraph of the introduction. And I stopped there, and my life profoundly changed that second. If any of you have had the epiphany in your life, you'll know what I'm talking about. This happened to me. I knew why I was here on earth. I know what I was here to do, and it sounds corny, but that first paragraph of the introduction brought me back to my economics education at the university, Virginia Commonwealth University, and Economics 101, which is the most important course I ever had in my life. And all of a sudden I saw Wall Street clearly. All the obfuscation that you have on Wall Street, all the obfuscation and research by three-piece suits from every major school you can possibly imagine, this cut right through it. And as I read this paragraph, in essence what it was telling me, if there are more buyers than sellers willing to sell, price must rise. If there are more sellers than buyers willing to buy, price must decline. If buying and selling is equal, price must remain the same. There's nothing else. You can send it to MIT, have it macerated, put a square root over the top of it, make it as difficult as you want, but the end result is the irrefutable law of supply and demand. And it hit me between the eyes because that's exactly what Econ 101 meant to me. I used to go to the supermarket when we were learning elasticity of demand in class. I was on GI Bill going to school. I spent 4 years in the Navy first and then went to school. And I was on GI Bill, and I remember going into the supermarket without a penny in my pocket, and I would go around and I would learn about elasticity. I would go to the drug department. I'd say, insulin, perfectly inelastic. Given change in price, yields no change in demand. Then I would walk over to the beef department, and I'd look at steak. I'd say, unitarily elastic. Given change in price, unitary change in demand. People will switch from steak to chicken, given a given price. And I went through the whole store with all the elasticity of demand, totally intoxicated, and I walk out with nothing. Because I got nothing. I'm driving a car that's got no reverse in it. But I understood. And that stuck in my mind. But then as I went to Wall Street, all the obfuscation began to cloud that out, and I'd kind of forgotten about it. And to me, all there was is a research report you got from Merrill Lynch in New York City, and that's what you purchased. Until that day when I read that first paragraph of that introduction, it came back to me and I said, my God, if there is a holy grail of investing, this is it. The irrefutable law of supply and demand. That's simple. You can take a funnel and stuff all the research you want to stuff down that funnel. I don't care who wrote it. But in the end of that funnel, when you get to the end, it's the irrefutable law of supply and demand that causes price to change. Plain and simple. Whether it's your shirt you're wearing, the car that you wear, the shoes that you're wearing, Econ 101 affects your life profoundly. And that's when I thought to myself, I know this is the one piece of the equation that no advisor that I know does. When they look at a book, one half is fundamental analysis, the other half is blank. Fundamental analysis, blank. Fundamental analysis, blank. Fundamental analysis, blank. The blank side was the technical side. And I didn't even like the idea of being called a technician because 90% of technical analysis I don't believe in. But Econ 101, I do believe in it. And Statistics 101, I believe in. And I found this. And this methodology was developed by Charles Dow in the late 1800s. Wasn't new under the sun. Wasn't something I created. Charles Dow created it. In the late 1800s, he created a methodology called figuring. What he would do is he'd take a piece of chart paper. As the stock began to rise, say from 30 to 35, 30, 31, 32, he would write the price of the stock in the box. You would look at a piece of chart paper. Then as the stock would begin to reverse, he would shift columns and reverse the order. So 30, 31, 32, 33, 34, 35. Then as the stock falls back, as they do, they move up and down. He would shift and go 34, 33, 32, and so on until a chart began to form. And he found that there were patterns that had a tendency to repeat themselves. Well, it got really high-tech in the early 1900s. Instead of writing the price of the stock in the boxes, they used X's and O's. Excuse me. The X represented the stock rising. The O represented the stock declining. And that's as far as it has gotten in all these years. That's as high technology as this methodology has gotten. We can do things much faster now, because in my option strategy department, once I came across this at the Virginia Beach with my wife, that's what we did. That was the underlying work that we did to come up with the option strategy ideas. So by the time I ran that department for 9 years and realized that I had to start my own company by age 40. 40 was the cutoff. So at 39, I turned in my resignation. I grabbed my second in command in my department, and we went down the street, and we started Dorsey, Wright & Associates with $90,000 borrowed from a firm in New York City. We owned that back with interest, and we gave up, I think, 37% of the company to get it. That was a deal the mafia wouldn't even think about giving it. They would be embarrassed to give it to you. But it was all we had. My wife was pregnant. We had 2 young sons. No money. I gave up being a senior vice president of this firm and walked down the street because I knew this is what I had to do. I had to teach this methodology to my brothers and sisters in this business for the rest of my life. So that's what Dorsey Wright was all about 28 years ago. We're teachers, plain and simple. To work at Dorsey Wright & Associates, you have to be a teacher, because that's what we do first and foremost. I knew in the beginning my just desserts would be a little old lady who lived out in the country who had a better life because she dealt with an advisor who was trained, educated, and supported by us, Adam. That's my just desserts. So if you ask my wife, what did you think about in 1987 for your financial future? What did you hope for? She would tell you, we hope that at some point in our future we could save $10,000 in the bank. That was it. Free and clear, mind you. But $10,000 in the bank, that was all. We had no expectation. We wanted to do the right thing, to teach people, to preach to people, and to bring people into the fold who would then go out and help you. Because the ultimate for us was you. The way we got to you was through the professional. We couldn't get to you by any stretch of the imagination, but the ultimate result was that you do well. So we started out. When you think about technology, back in the day when I was a stockbroker at Merrill Lynch, high technology was a pneumatic tube. When we wrote an order, we put it down a pneumatic tube, and it sucked down to the guy in the back who took it out, and he was a teletype operator, and he would type it up, and then it would go up to the New York Stock Exchange. They would rip that off. They'd take it out. A runner would then take it out to the post. The post would execute it. He would take the money back to the teletype guy. He would type it back up. It would come to Richmond, Virginia. He would rip it off, put it in the tube, and you would hear big sucking sound. And there was an order that came back, and that's what happened. That was technology. That was high technology for us, a pneumatic tube. We had a ticker tape in the front office that clients came in and sat down and looked at the ticker tape every day. They took their lunch, brought lunch in, watched the ticker tape. I'm not sure anybody knew the symbols, but it was fun to watch it go across. And then you had the news wire that we would look at about every half hour, only because it was cool to look at it. You'd pull the wire down, it was spring-loaded. So when you let it go, it'd roll back up. So every half hour, you'd stand up there like you're looking at the information. You have no idea what you're looking at, no idea what you're reading, but you'd pull it down for about 5 minutes and let it spin back up. And that was pretty much what we did back then. And then get back on the phone and sell what Merrill Lynch is selling to you. Well, today, technology has just gone by leaps and bounds. At DWA, we started with a skeleton crew. I mean, it was Watson and myself. We had a secretarial desk, a couch, and a small office about the size of that corner over there, and that was it. So one of the first hires was a young lady named Tammy DeRosier. In fact, He said, I'm retired. I'm working more now than I ever was as CEO of the company. I can tell you that much. But Tammy came to me in the most unusual way. And we have had zero turnover at Dorsey Wright & Associates for 28 years. No one's ever left. And one of the first people I hired, she was 16 years old. And her mother was a teacher's aide to a teacher who was my cousin. And my cousin was the teacher, and her mother was saying, you know, I got the darndest daughter when the bell rings and everybody's running to see who's dating who in the weekend and where they're going. My daughter goes to the phone and picks it up and calls her broker. He says, she's 16 years old calling her broker. She says, yeah, she's trading index options. Index options, not even experienced people were trading index options back then. Well, her broker happened to be my mentor, who I sat right behind at Merrill Lynch, Tony Fadul. So my cousin said, well, you better get her to meet my cousin who has a company now that does these kinds of things. They need to meet each other. So she didn't drive the car. Her mother drove her in. She came up, and I gave her some books, and I gave her some videos to watch, and she now runs DWA. I gave her some videos to watch, and she came back in 3 days, and she'd finished them. I said, I can't believe it. I said, you've actually gone through all of these? She said, yes, I have. And I said, oh, my Lord. I said, okay, what are you doing Christmas, Easter, midterms, weekends, and summers? Because I know you're in school. You're only 16. She said, nothing. I said, okay, you're hired. We don't have any money, but I'll figure it out. So she started then working part-time in the firm. And I knew right away that she would ultimately take over, so I attached her to my hip for 28 years. And she has exactly what I expected in the beginning. She's there. And Susan, who's the head of research, came with me about the same time. Susan wanted to work her way through college. She was going to be a neurosurgeon, but then when she heard me speak one time, she said, I want to do this stuff more. So she came with us, and Susan is still there too. So I always had Tammy on my left side, Susan on my right side, and the company is pretty much run by women now. I mean, they're the powers. But at any rate, we've had no turnover over 28 years. And we used to update charts by hand every day. We had no technology. We started the company with a Tandy 3000. That's in the Smithsonian Institute. It doesn't run anything. There's nothing. You can Google it and see what it looked like, but it did nothing. So we updated 2,500 stocks by hand every day. At the end of the day, we would put X's and O's in the chart. 5 analysts would do 500 stocks, pass that book to the next analyst, so that by the end of the week, every analyst had seen all 2,500 stocks. We did that for years on end, every day. So when an advisor would call up, let's say like Adam here, and he'd call and say, Tom, could you look at Netflix for me? Sure. I need the gray book. And the gray book, because I knew that was the ends. The gray book would fly in the air, and I would catch it, open it up to Netflix, look at the quote system, update it, and give him my opinion on the stock. That was technology for us. Until I read a book. And all these little turns in my life, had I not taken the turn when they happened, which is the reason I believe it's manifest destiny, I could have gone off. I could have been on a trip to Japan and ended up in Australia. But I took all these little turns that came in front of me. And I read this book called Unlimited Wealth by Paul Zane Pilzer. And I realized that my economics education was really out of date. And this book was on economics. It wasn't one of those rah-rah books. It was on economics. So I came back into the office one day and I said, this is an all-hands evolution. I don't care what it costs. We'll figure it out. We need our own charting system. We need to be self-contained ourselves. No more updating these charts by hand. Once you have a vision, the plan falls into place. Having a plan is very hard. You got to work a plan. Oh, I got to do step 1, step 2. Oh, Lord, step 3. I go, no, back to step 1. Once you have the vision, the plan automatically falls in place. The next week, a guy walks in our door. He says, I hear you're looking for a computer programmer. I said, we are. He said, I'm the best in the world. Now the guy's wearing polyester pants. He's got a black leather jacket on and kind of long, greasy hair. I'm looking at him. I'm thinking to myself, you don't look like any programmer I know. He says, but I'm the best in the world. And I said, well, how much do you cost? He said, $40 an hour. I said, okay, you're hired. Figure it out. Within a week, we started having our charts, and he built the whole system. We built this whole system, one of the largest portfolio and charting systems in the world on the internet, with one guy out in the Midwest, outsourced to him, and one guy who was the head of technology at DWA. Jay Ball, who was from BMI, is the head of my technology. And I said, okay, Jay, now that we're going to be in the technology world, and this is the way we did things. We're a small company. We're in a technology world. You have a degree in engineering, so you're closer to technology. We're business. So now you're head of computer systems. He said, I can't even type. I said, learn to type, but now you're the head of it. So he and this guy in the Midwest built one of the greatest programs you can imagine. We've rewritten the program in more up-to-date language now, but it's probably the largest portfolio and charting system in the world on the internet now. And all these things happen by accident, by reading a book. How did I get my hands on that book? Somebody gave it to me and said, you need to read this. These things have happened to me all the way. As we started this business in 1987, like Adam mentioned, 10 months later, the market crashed. So what happened here the other day? Nothing new to me under the sun. Picture you came in to work, and all of a sudden you turn on CNBC, and you see the market's down 8,000 points. How would you feel the other day if that happened? 8,000 points in a day. Really, how would you feel? What do you think CNBC would be saying? What would Fox News be saying? What would all the newspapers be saying? It's the end. It's the end of the world. We've been there and done that. 1987, that happened, 22% in one day. We lived through it. We made it back okay. By the end of the year, the market was up. If you ask Rip Van Winkle, well, how was the market? How were things going? Well, it was a tough year, but it wasn't too bad. We're up about 2% for the year. In between there was right bad. But we lived through that. We lived through 72 through 74, the point where the blood came out drip by drip by drip. In 1980, the same thing happened. Jimmy Carter was in office. Inflation was running rampant. You could buy a treasury bill for 18%. How would you like to do that now? 18% treasury bill. How do I know? I bought my dad one. Absolute inflation like you couldn't believe. Along the way, there were rallies in different types of sectors, though. In the 1970s, we traded oil. That's all we traded because the oil embargo caused oil stocks to go up. Nobody wanted to hear about anything but oil. In the late 1970s, it was all about gold and silver. Do you remember that? I see some of you here got some age like me. Remember in the late 1970s? If you owned a barbershop that was called Gold's Barbershop and it was listed, it went straight up. It didn't make any difference that all they do is cut hair. And that was one of the wildest times I'd ever seen. Well, this too passed. This passed, and I knew the exact date that it was going to pass is when Wheat First Securities decided that we would have a citywide symposium on gold. We're going to invite everybody in the city. Well, we had the biggest attendance you could possibly imagine. Gold was around $800 a share. More mink coats came to that seminar than you could possibly imagine. That was at the top. At the same time, you could see TV. If you all remember back in TV, all of the older citizens were taking their silverware in the boxes and carrying it into the pawn shops. And silver was like $50-some dollars. They knew what they were doing. They sold their silver at $55 an ounce, sold all of that out, and investors kept on going until it was over. When it was over big time. The Hunt brothers were trying to corner silver. Shame on them. But at any rate, there's another crazy thing that happened. In the 1980s, the next big thing that happened was gambling stocks. Bally Manufacturing makes slot machines. All kinds of other companies in Las Vegas that were listed, like Sands and things of that nature, went straight through the roof. Didn't matter. Gambling was going to be the next big thing. In the 1950s, vending machines were the craze in the 1950s. So there's always something. Do you remember what happened in the dot-com craze? That was the wildest thing that I've ever seen in this market. The dot-com craze in the 90s up to 2000, it got so easy to make money that you had doctors and dentists giving up their practices to go to these little operations where they could rent a desk with a computer on it and trade. It ended bad. It was never going to end. Every single newsletter that came out that was a technology newsletter, told you to keep buying and keep buying and keep buying. It can't end. We need storage. EMC was one of those companies. We'll always need more storage. EMC can never stop going down. Nobody ever thought about the cloud. All of a sudden, we didn't need any more storage. We got all we want up in the cloud. So in the year 2000, all of a sudden, this came to an end. We came into the year 2000 with our relative strength worked long. In other words, we owned technology, we owned internet, we owned telecommunications, we owned all the T's. By April of 2000, we were out of them totally. Relative strength forced us out. So one of the things that we did, and we have been able to negotiate these types of markets that have been as wild as can be. 2008, we went through the year not owning any equities whatsoever. Happened by accident again. Another one of those detours that came into my life that I took. We had two fellows come to Dorsey Wright and Associates that wanted to start Dorsey Wright and Associates Money Management. I said, we're not going in that direction. We're a research operation. But these were two guys with the highest principles and integrity and honesty and character and loyalty that you'll ever find. And when you find people like that, you go ahead and do it. So we started in the money management business. 5 years later, I was at wit's end. I would be talking to a group of advisors, which is typically who I speak to as professionals, not individual investors. This is a special night for me. And I would have a hand come up in the back and say, Tom, I've been doing what you guys do. I've read the books and whatnot. I've changed my business around, like Adam might say. And I sent some money out to you guys in California. Is there a disconnect? Do they do the same thing that you do? Because I'm not doing anything out there, but I'm doing it with you. And it got to a point where I couldn't take it any longer. And it was time to sit down and think about what the problem was. We got to get this right. And again, here's another road that I take, accidentally, but this was like thrown in the way that it's supposed to happen this way. And when we began to look at the trades and find out why a particular stock was held or why a stock was purchased, and it came back to emotion, the problem. How can you hold on to General Electric from 67 to 23? It breaks every covenant that Dorsey Wright and Associates has, everything that it has. Nothing suggests that we do that. And the answer would be, well, Jack Welch is running the company. The earnings are going straight up. It's great. It's a Dow Jones stock. We knew it would come back. You knew it would come back. Did an angel come down here and tell you that? Because if you knew it would come back, I would like to put every penny that I have in it and leverage it and ride it back up. So the net of it all is emotion, and we had to get the emotion out of the equation. So we hired a fellow named John Lewis, great guy, who was very computer-oriented, been in the money management business, knew what we did, came in and helped us create a computer system that would do the same thing that we would do by hand. No algorithms, no MIT stuff, none of those things, no flash crashes and trading. Same stuff we did by hand, updating 2,400, 2,500 stocks a day. The computer was told how to do these things. And relative strength charts are something that we did back in the beginning 28 years ago. And you divide one thing by another. If you've been to fourth grade division, you can do everything we do. In fact, there was an article written on me in Market Watch back in October of 2014, and the name of it article, I just love it, says, everything you want to know about investing, you learn in grade school. It's true. Relative strength, we have found, is the most important part of the equation. Relative strength, momentum. How do you do relative strength? You divide one thing by another. If I want to compare Coca-Cola and Pepsi-Cola, I'll divide the price of Coca-Cola by the price of Pepsi-Cola. I then get a number by that division. So let's say Coca-Cola is at 100, Pepsi-Cola is at 50. I'm just pulling those numbers out of the air. And I divide Coke by Pepsi, 100 by 50. I get a number of 2. I'll multiply times 10, make that 20, and plot it on a chart. So the chart looks like it's a regular trend chart, but it isn't. It was created by dividing one thing by another. Once we did that, we got that number, plotted it on the chart. It gave the same buy and sell signals, simple buy and sell signals, that I could teach a 7th grader to do in 10 minutes. Same buy and sell signals that would tell us whether we should own Coke or Pepsi. So if I asked you here, can you pass the Pepsi test? Do y'all remember the Pepsi test? Blindfolded, can you tell which one is which? Y'all believe you could do it? Come on, how many hands here think you could do it? This side of the room more than this side. At any rate, I did that at the Jefferson Hotel about 3 months ago. I was having dinner there, and I ordered a Coca-Cola. And I tasted the Coca-Cola, and I said, this is Pepsi. So when the waitress came back, I said, is this Pepsi-Cola? She said, no, we only buy Coke products. I failed. So then let's say in your portfolio is only going to be Coca-Cola and Pepsi, nothing else. Zero. I could look at a fundamental report. I could get a report from Merrill Lynch or Morgan Stanley, and Morgan Stanley looks at Coca-Cola and says, this is a fine company. It is fundamentally sound. Warren Buffett owns a ton of it, keeps buying it. Pepsi-Cola over here, I could look at that from Goldman Sachs. Goldman Sachs is fundamentally sound, wonderful. Now what? Which one do you select? Because you're only allowed to have one in your portfolio. You have to make that decision. Now what do you do? Number one, you couldn't taste the difference. Number two, you got two fundamental reports that say the same thing. And now I got to find out how to put that into my portfolio. That's where relative strength comes in. So when I divide one thing by another and I create that chart by doing that, it tells me if it's in a column of X's and rising, you should own the numerator. If it's in a column of O's and declining, you should own the denominator. That's it. That's it. That's momentum. So we did that 200 times a week. We updated 200 charts by doing those division because we had no computer that could do it. Today that we operate in the cloud, we do 8 million relative strength charts. A night. Not a week, a night. We compare everything. Malaysia to Indonesia, Indonesia to India, India to China, China to Germany, Germany to the United States, everything in the United States to each other. It's one big arm wrestling contest. We never thought we could do that, but 28 years ago, we did it by hand. Now we're in the cloud, and we do things that are just absolutely amazing. So we created along the way, one of the things that happened in 1975 was May Day. The SEC deregulated commissions. Back in the mid-'70s, you paid high commissions, and all of us charge you the same thing. If you were paying Weber, Jackson, and Curtis, same thing as Merrill Lynch, Pierce, Fenner, Smith, same thing as Bayshore, Halsey, Stewart. Everybody paid the same thing. May Day 1975, deregulation of commissions allowed anyone to charge whatever they wanted. So that was the beginning of fees starting to become compressed. Because back then the spread between the bid and the ask could be a whole quarter of a point, could be half a point. Today it's a decimal. It's 1/10 of a point, 1/10 of a percent. There's something else that happened in 1975 too. Charles Schwab started. 1975, Charles Schwab started his operation and went countrywide. He first started in San Francisco. That's where Charles Schwab was. Then he went nationwide, 1975. That was the first shot over the bow that the DIYers, do-it-yourselfers, you can do this. You don't have to deal with me at Merrill Lynch. You can go to Charles Schwab, open an account, and make your own decisions. But we laughed at them. Are you kidding me? I wear a three-piece suit, man. This is when you call me up and you want a Standard & Poor's sheet, I can mail it to you. That was technology, was the mail. Charles Schwab, you just call him and give him an order. But we laughed at Charles Schwab. Ultimately, what happened? Wall Street went bankrupt. They all had to sell out to somebody, sell out to banks. And along the way, the banks bought them up, and there was no longer a partnership. So once the partnerships gave up the ghost and went with the banks, now you went to a bank mentality. So what happened was we were commission brokers back in the 1970s. Then as we went to a banking operation, we became fee-based. The banks are fee-based. That's all they understand. Charge a fee. If
If you overdraw your checkbook, you charge a fee. We charge you a fee for everything. So they went in that direction. Well, Dorsey Wright, I always looked at us as a pilot fish. Y'all ever seen a pilot fish? Google pilot fish and click image, and you'll see it. You see a shark. A pilot fish always follows a shark. It's right next to the shark. Nobody's going to eat the pilot fish because nobody's getting that close to the shark. So the pilot fish, whatever direction the shark goes, the pilot fish goes with it. That was us. If Merrill Lynch and the big group went in a particular direction, we needed to do the same thing. So we had to hone our craft to accommodate the sharks. And that was okay because we were moving into a different realm now. People were starting to think more about their retirement. The defined benefit plans were basically gone. They had turned the defined benefit plans into 401ks. Now you were responsibility for your retirement. You got much more serious. You didn't call your broker up and say what's hot, what's not. Now you had to protect what you had for retirement. So we began creating products that would go down those lines. These products were models that we created that would automatically run. So because we understood relative strength so well, we were able to create models that would run themselves. They would do the exact same thing that we would do if we were doing it by hand, except the computer now does it. So it allowed us to take our hands off of it, let it do exactly what we told it to do, and now we really started to take off at Dorsey Wright & Associates. This led us to bringing out the first exchange-traded fund, which I'm going to talk about exchange-traded fund in a moment, but bringing out the first exchange-traded fund, and we now have over 100 models that automatically run every day. And these are the kinds of things that Adam uses because as the architect of your account, he's the one who has to select the right model for your type of risk tolerance. So he's the chef. He's still got to go in the pantry and select the right one, but we're going to provide you with all the bricks that you need to build this house. So along the way, we came out with the very first technical analysis-based exchange-traded fund ever, called the Dorsey Wright Technical Leaders Fund, symbol PDP. And I'm going to show you what these exchange-traded funds are. But let's just hit last week for a second. When I look at what happened last week, down 1,100 points in one day, there were some interesting things that happened that I'd like you to Google Rule 48, New York Stock Exchange, which allows the market makers, if there is no buying and selling in a particular stock or ETF, it allows them to make their own market. So what they did is they made markets that were like, in one of our ETFs, it closed at 22, it opened trading at 11. That's because no one was willing to trade. No one would step up to the plate. And the ones who did put market orders in. Remember this, never put a market order in on a day, on an opening like on a Monday, or a stop order. When you put a stop order in, it's saying awaken my order and sell it at the next best price. And that next best price could be down 50%. So what happened as far as numbers are concerned the other day? Nothing. I mean, when you compare that to what it could have been like in 1987, down 8,000 points in one day, no big deal. We already have our indicators now with the things that we do know in the market. We know that our most important long-term indicators are reaching levels that we haven't seen in years, which are oversold levels. We typically see bottoms at that point. The short-term indicators are down at the same level. If you look at a normal distribution of the market, which is a bell curve, y'all remember in Stat 101? Remember the normal distribution bell curve? If you looked at the Standard & Poor's 500 with the symbols all under that bell curve, just out like that, it's all skewed to the left, 3 standard deviations below trend. When you get to a condition like that where it's skewed to the left-hand side, it's the scariest time in the world, but it's also the point when you're 3 standard deviations below trend, the probability of a regression back to mean is extremely high. So if I was on Fox television today and they said, what do you think the market will do over the next month? I said, I think it's going to, over the next quarter, I think it'll be much higher than it is now. Mainly because of how far skewed it is. But I also reserve that we got September and October coming. Those have been typically pretty bad months. The indicators that we have, the short-term and long-term, have not reversed up yet, have not suggested the offensive team is back on the field. The defensive team is still on the field. Once that changes and reverses up, then Adam will be notifying you. Until it changes, there's no point in doing anything. So in the words of J.P. Morgan, when he was asked what he thought the market would do in the 1920s, he said, it will fluctuate. This we know. So at any rate, let's go ahead and begin the PowerPoint. I want to educate you on what exchange-traded funds are all about. I love it here in Columbus. We're on, what was the name of that street we're on today? What was it? High Street. Yeah, High Street. We went down High Street to a cigar bar, went in there, had a nice Davidoff cigar this afternoon. I like this place, very nice. Is Cincinnati bigger than Columbus? No. No? Cincinnati smaller? Or you all just look at it that way? Because when you say big or small, that's all relative. I mean, Cindy and I live in a small place. It's called Bon Air. And I'm telling you, it's so small, we had a prize fight the other night. Both fighters had to sit in the same corner. I mean, that's a small county. But at any rate, let's begin. Do I just begin to push down on this here? Exchange-traded fund. What's an exchange-traded fund? Okay. Exchange-traded fund, I want you to think of it like a school of fish. The beauty of the exchange-traded fund is it has to be transparent. You can know at any given second what is in that fund. Take our Technical Leaders Fund, the PDP. It has 100 stocks in it. You can see what they are, what the weightings are. It's there for God and everybody to look at. Unlike mutual funds, you have no idea what's in it. You have no idea what the manager is doing with it. And you have drift, what's called drift with mutual funds, where they say they're doing something, but do something else. So the exchange-traded fund can't do that. It's like a school of fish. NASDAQ 100 is an exchange-traded fund. It's the 100 largest stocks that trade on the NASDAQ. That's it, plain and simple. You could select one of those stocks out of that NASDAQ 100 and say, I think I just want to buy one of those stocks. You increase your risk tremendously. If you believe the NASDAQ is a place to be and you want to be in the top 100, you can buy the NASDAQ 100 exchange-traded fund. Trades just like a stock, has a symbol just like a stock. But you now buy the whole school of fish rather than one fish. Analogies hit me all the time. I don't know why. Every time I look at something, I say, another analogy. Flying up here in a plane. I'm watching the pilots. And all of a sudden, the analogies are flying through my brain, exactly what Adam does with your portfolios and how he goes about it. Any of y'all see MasterChef? Watch that show? I love that show. But when they go into the pantry, they get the requirement to make a particular dinner in 1 hour. And they say, okay, the time starts now, and they have to run into the pantry. This is what Adam does every day. Our pantry is about 3,000 exchange-traded funds in every persuasion you can think of, every way you can think of it, just like the produce in here. So on this show, if you were told to make a particular dinner and you're competing with 15 other people, now go into the pantry, you've got to select the ingredients. Not everyone's going to select the same ingredients. It's up to you to select it. You're the chef. The same as Adam is the chef in your portfolios. He's going to select the exchange-traded funds to go into the programs that we provide. So whenever I see MasterChef, I see exchange-traded funds. I don't see produce. Everything here could have a symbol on it for me. When they're putting it in the basket, the selection process, to me, each basket is a portfolio. So what Adam's doing there in that MasterChef pantry is he's selecting the proper exchange-traded funds to put into your portfolio, which is the basket. Every time I see this show, that's what I think about. When the dinner is finished, that's what you have. You start back here, you go into the pantry, you select what you want to select, you make the dinner, and here's what you end up with. And you've got to stand behind it. And Adam is making this dinner, and he has to stand behind it with you, plain and simple. He has a rules-based process. He knows exactly what the rules are. He needs to stick to the rules. There is no gut feeling here. We know exactly what we're doing. And you follow the rules. I saw this on the net, and I had to put it in here. I'm thinking, man, that's where I want my portfolio to look. This is braised pork belly with rice, crispy kale, and maitake mushrooms. That's where I want my portfolio. Maybe I might be a little bit aggressive in my stance in the portfolio, but I look at that thing, I said, hey, that's my portfolio. These are made up of exchange-traded funds. ETF alchemy. What can you do when you go into that pantry to select them? H2 plus O equals water. What can I put together that will go together? With our PDP, which is our technical leaders, we also add that. You can add that to the Standard & Poor's low volatility. What I have is the engine here, and I have the brakes over here. I put the two together. Once I put the two together, I have a different product. That's the idea with dealing with a professional who knows how to put these things together in what I coined this term, ETF alchemy. What goes together? The ubiquitous egg. That's one ETF. Symbol is EGG. Well, what underlies that egg? This would be all the stocks that underlie that egg exchange traded fund. These are all the vitamins you find in the egg. Selenium, folate, biotin, calcium, cephalin, lectin, all the way down here. That's all inside that egg. That's the exchange traded fund. When you open up the egg and look inside, just like you can any exchange traded fund, you just go on Google and you type in the symbol, click it, and there it is. So when you look at your portfolio, each month you can go take the symbols, put it on Google, type it, and you see exactly what's in it. And you put this here, symbol EGG, that's what's inside of an egg. Well, what is our PDP? What is our technical leaders? It's a heat-seeking missile. The relative strength that we just talked about, that we did between Coca-Cola and Pepsi, remember dividing one thing by another? Coke was 100, Pepsi was 50. I divided 100 by 50, I got 2. I simply made it larger by multiplying it times 10, and then plotted it on a point and figure chart. It's either an X's or it's an O's. That's simple. So what do we do with the 100? Out of 1,000 stocks, we do that calculation I just told you on Coca-Cola and Pepsi 1,000 times. No, more than 1,000 times, because every one of those stocks has to go against every other one. Here's the way I look at the additions to it. It's like a baseball game. You ever watch a pitcher in a baseball game? He starts out doing fantastic, but by inning 5, they start hitting home runs on him. He starts walking some people, too many people, and the coach walks out to the mound. He says, "What's wrong? What's wrong, Billy?" He says, "My arm's getting tired, a little bit tired." He says, "Okay, why don't we just you go back in the dugout, and I'm going to go over to the bullpen, and we're going to find somebody who can really throw." So they move him out. They change one, they take the pitcher off the mound, they bring somebody in from the bullpen, and they replace him. It's exactly what happens here. The same relative strength calculation we just did between Pepsi and Coca-Cola, we're doing this all the time, and once a quarter, we find the ones that are beginning to walk too many players and getting too many home runs hit on them, and we replace those with a group from the bullpen. That's it, cut and dried. That's simple. So that's how stocks go in and out of the portfolio, just like pitching. So next time you see a game, and you're watching a game on TV, and you see the coach go out there and talk to the guy on the mound, that stock's not doing well. It's probably going to come out. And we take it a step further, the Callahan Periodic Table of Investment Returns. This is interesting. Forget the name of its Callahan Periodic Table. This is just showing you what has performed the best going back many, many years. Going back to 95? It's so small up here I can't even see it. 95. So going back to 1995, you can see 95, 96, 97, 98, the Standard & Poor's 500 was the best performer for that year. The next thing that happens is you begin with emerging markets in 1999. And the year 2000 and 2001, what happens is that fixed? I can't even read it. It's so small on this computer. Russell 2000 moves in. Here's something that happened in the year 2000 that hit us between the eyes. By doing those relative strength calculations, again, Coca-Cola by Pepsi, however, we do it with everything, all of a sudden, for the first time in many years, the relative strength charts turned positive on small cap stocks over large cap. It had been 5 years since we saw that happen. All of a sudden, one day that happened, it turned up and it said own small cap stocks. At the same time, it pointed to owning no longer growth stocks, but value stocks, which are the ones that are beaten down and fundamentally sound. It said you should own equal weighted stocks versus cap weight. What does that mean? Capitalization weighted is like Congress. Every state gets so many congressmen. The biggest states get the most congressmen. So the cap weighting for California is much higher than Rhode Island. Rhode Island has very few congressmen relative to California. That's capitalization weighting, meaning in the Standard & Poor's 500, the top 40 stocks pull it all the way around in the cap weighting. The equal weighted, which has outperformed the Standard & Poor's cap weighted, hands down by almost, probably over 100% over the last 15 or 20 years. Equal weight is the Senate. Every state gets 2 senators. So by taking the same 500 stocks and making one capitalization weighted, where the top 40 stocks have all the votes, versus the symbol RSP, which is the same 500 stocks, but each stock has an equal weight. The last one, the smallest one in the 500, has the same vote as the top. Trade totally differently. Totally differently. You never, ever hear on TV anyone talking about the equal-weighted S&P 500. You know why? It beats 99% of the money managers out there. You're not going to talk about that. But a problem that you have is, like if I asked all of you here, would you like to have your portfolio managed in the top 25% of all money managers in the world? The answer is probably yes. But that's just saying that 75% of money managers, mutual fund managers, never outperform the S&P 500. But the problem you have with that is if the S&P 500 is down 20% this year and you're down 19%, you outperformed. Your money manager gets a vacation to Bermuda. Oh, he's down 19%, but he outperformed. That's the big Wall Street thing. You know, they don't talk about that very much. He's going to Bermuda, you're down 19%. The next year, the Standard & Poor's is down 20%, he's down 19% again. He goes back to Bermuda, you're down 38%. Is that what you really wanted? You're in the top 25% of all money managers. The problem is there's no risk management being done. So when you look around along the top here, you can see what has performed the best. And look at emerging markets. When you look at the mid-2000s, emerging markets were the place to be. The worst place you could have invested in the mid-2000s was the USA. You wanted to own Indonesia, up 300% a year. You wanted to own Korea. You wanted to own Malaysia. You wanted to own Singapore. Not in the United States. But these are the things that we ferret out through our relative strength. By that arm wrestling contest, like we did Coca-Cola and Pepsi, we can see where the strength is and we move toward the strength. The theory of motion is an object in motion will stay in motion until acted upon by an opposite force. That's exactly what happens in the stock market. When you think about your 401k, one of the best ways to manage a 401k is by taking the lineup that you have in that 401k, simply rank them from top to bottom each quarter, which one produced the best, which one was the worst, by the top 5 and carry it through the next quarter. That's momentum investing. That's simple. So when you look here, you can see exactly what's performed the best. 2014, S&P 500 was the absolute best. And then you can see all the colors around here too. So notice here, S&P 500, notice that kind of brown color at the bottom here. You don't want to be in U.S. Equities during that period of time. So this just looks back and says, you know, things change. It's not unlike going to a supermarket. When y'all go to the supermarket, you know what sector rotation is. When you go to the produce department, you find you don't want to buy winter squash in the summer and summer squash in the winter. You'll find that tomatoes are less expensive, taste better, and have a longer shelf life in July than they will in January. You don't buy watermelons in January, you try to buy them in August. So produce comes in and out of season. The same thing as sectors come in and out of season. Healthcare is good for a while, technology is good for a while, but you've got to be watching these things and know when they come in and out of season. Our seasons are just the stock exchanges. Your seasonal investing or your seasonal purchases are the supermarket. You go in there and the same thing happens. We just look at things a little differently, but things move in and out of favor for us also. Now, here's what I wanted to do. And the answer is, how'd Johnny Carson do it? This is fun. Google, over the last 11 years, is up 1,521%. And y'all holding Google all that time? Well, there were 10 stocks that outperformed Google. The 10th stock that outperformed Google was Celgene, up 1,814% in the last 11 years. Wouldn't you like to have held Celgene? Human emotion prevents you from doing that because they move around a lot. Intuitive Surgical is number 9, up 2,064% for that period. Celgene is a global integrated pharmaceutical company. Intuitive Surgical, if you have had surgery, you may have been operated on the things that they build. They're focused on advanced surgical technology, up 2,064%. Next, you probably own this possibly, or you have it at your firm. Up 3,318% in the last 11 years. Beats Google hands down. Keurig Green Mountain. Y'all got those little packages you put in there for cocoa, coffee, up 3,318%. How many of you own Keurig? Y'all know it. Y'all use it. Alexion Pharmaceuticals, biopharmaceutical company, up 4,677%. How many of y'all own that? Apple Computer up 5,211%. I see some hands up with Apple. Do you own a lot of it? Netflix up 5,379%. Regeneron Pharmaceuticals up 6,856%. How many people own Regeneron? Salesforce Incorporated. They're immuno-oncology. The all-in-one number one customer relationship management company, Salesforce Inc., up $9,442 or percent. And y'all own Salesforce? Lastly, the number one out of those 10, up 11,251%. Makes Google look like a Boy Scout. Y'all know this company. Monster Beverage. You know that stuff you see there? It's got the crazy stuff on the cans and whatnot. And it's got that caffeine in it. Gets people all hyped up and whatnot. This is the Coca-Cola of 2015. That's what the kids like. That's what the millennials like. Monster Beverage. How much of Monster Beverage y'all own? I was thinking the same thing the other day when we did this. During the same period of time, 11 years of Google's performance, Standard & Poor's 500, cap weight, that would be Congress, is up 92%. The equal weighted Standard & Poor's 500, that would be the Senate, up 144%. Just in those two, which one of you would you prefer to own? And Google up 1,521%. So as we were doing this on the podcast the other day, I was thinking to myself, my Lord, why don't I own those? I'm watching this stuff. Why don't I own a ton of these stocks? I didn't know what Regeneron was. And then I went back over here and I looked at PDP, which is our technical leaders. Lo and behold, there's Regeneron, number 3, third largest position in the technical leaders index. There's Apple Computer, the 4th largest in that technical leaders index. I own a lot of PDP. I own a lot of those stocks and didn't know it. Why did I own those? I wouldn't have held them if I owned them outright because they're pretty wild. But what these do, what the exchange traded fund does, it's a heat-seeking missile that's going to put you where the relative strength is. It's going to put you where the strength is. It's going to take out of the bullpen the guy who's throwing the hot baseball, put him on the mound. That's what happens here. So my point being is, with exchange traded funds, you may end up owning the right stocks for the right reasons and be able to hold them because you're not sure what's in it. You know that the fund is the right thing. It's like a symbol to me. PDP is like IBM. It's just like Ford Motor Company, General Motors. It's PDP. But inside of it is that stuff. This is what you see, the egg. That's what's inside the egg. And what's inside that egg, when you're buying the egg and you want to own an egg and it fits in with your portfolio and it fits in with the dinner that you're creating, you're getting this. And that's where you get the boost in here because you end up owning these companies and probably every one of them, depending on the mix of exchange traded funds that Adam has put into your portfolio. One of the analogies that always hit me is I almost lost my life back when I was 21 years old. And I was a pilot, I was a young pilot, and I was flying a plane. I was coming back from Palm Springs for lunch, and I was a hot shot. And I wasn't supposed to be anywhere near clouds, and I'm climbing through clouds, and everything is fine. Next thing I know, my Omni goes out on the dashboard, and we didn't have much as far as instruments are concerned back then, and I'm lost. And I said, you know what? All I have to do is get to the coast because I'm right near San Diego, and I'm going to land in Brown Field, which is right past San Diego. No problem. If I just get to the ocean, I'm in good shape. And this is what happens to investors. And I look out that window, that windshield, and I see the ocean. It's as blue and as beautiful as can be. And I looked over at my compass, and it said, you're flying southeast. I said, I can't be flying southeast. I see the ocean. I need to see the ocean. I want to see the ocean. It's necessary that I see the ocean, and there it is, blue. That compass is wrong. You're flying southeast, partner. And as I kept flying toward that ocean, I kept flying southeast. I ended up landing that plane in a farmer's horse pasture 18 miles south of Tecate, Mexico. I finally had to put that thing down. I didn't have any more fuel in the right tank. Left tank was almost empty. I had no choice but put a soft field landing in and land that thing. And I didn't even know I was in Mexico then. I knew it was getting right scary. But all of a sudden, the pickup truck comes up to me full of Mexicans, and I looked at the driver and I said, am I in Mexico? He said, sí, señor. I said, this is going to be a bad day. But the point is, I didn't look at the indicators. I didn't believe the instruments. That instrument said southeast, believe you're going southeast. The indicators that we use, if the indicator suggests defense, believe defense. If it suggests offense, believe offense. If you need to switch out of a particular sector or an index or exchange traded fund, believe it because the indicators are telling you that. I almost died that day. Wouldn't have taken much to be the end of my life at 21 years old. So let Adam watch the indicators because that's what he does. You know, a Harvard professor once said, people don't want the quarter-inch drill. They want the quarter-inch hole. And that's what you all want. The last thing you want to do is come home from a hard day's work, whatever you do, if you're retired or you're playing golf, and come goof with this stuff. You want the quarter-inch hole. So I've taken enough time. I'm not going to take all the time. It's only 8:28 right now. I'll give you some time to go watch As the World Turns and all my children. And I want to leave you with what I always tell my wife. when she goes to the beauty parlor, good luck to you.
Guys, if we don't have any more questions, can you please join me in thanking Tom for coming out tonight?